So after about a 50 basis point drop over the last few weeks, treasuries did come up slightly at the end of last week. Now, that was because there were about 14 different Fed speeches last week. And in case you didn't tune into any of them, which I'm sure most people didn't, I'll give you a quick summary of what they said. Now, Fed Chairman Powell basically said that he's not really confident the Fed's done enough to bring inflation down. While Cook said global tensions could change the U.S. economic outlook, Waller said Q3 growth was a blowout, but new data suggests a slowdown. Barkin said we're still yet to feel the full effects, and Bostic said rates are likely sufficiently restrictive. So that's a lot of the stuff that we've been talking about over the last few weeks. And of course, I have been impressing upon everyone that treasuries will continue to be volatile. But the good news is generally the market feels that we are off the highs of about 5%. At least the 10-year treasury surpassed 5% for a hot second. And so did the 30-year treasury, I believe. But so I think we're still going to see some volatility in the market. Yes, there are clear signs that, or the data is starting to show that consumers are pulling back, that the jobs data is not as strong as it looks or has been in the recent past. So it seems like generally the market is feeling like we're going to start seeing some of those, good or I guess not good data coming out over the coming weeks and months, meaning good for interest rates, bad for the economy, which is essentially what we need in order for the Fed to feel like rates are sufficiently restrictive and they don't have to hike rates anymore. Generally speaking, I think they're done hiking. I don't think that they're going to go up anymore unless we get some really crazy good data coming out. But it seems that the treasuries have been doing some of the work for the Fed, and that I really don't think they're going to have to raise rates anymore. So basically, there was this Bloomberg article that came out this morning that says UBS strategists predict the Fed to cut rates 2.5% to 2.75% in 2024. So they're basically saying that a lot of this news is going to start coming out poorly in the spring of 2024, and the Fed's going to have to cut more than what they anticipated. Now, the overall market is betting on just a cut of just 0.75 of a point. So we're going to have to see what happens next year. In all likelihood, it might be something between 0.75 of a point and that 2.75 on the high end that the UBS strategists are forecasting. The one thing that I think we can all see, most of us can see, if you pay attention to what the Fed's doing and saying, is that they seem to always take it too far, right? So they basically said inflation was transitory and that they were only going to raise rates 0.75 of a point. And here we are 5% later at raising rates at the highest pace in history. So why would we think it'd be any different that he's going to obviously wait too long to start cutting rates and then he's going to have to cut more aggressively than what he's forecasting? So there is a very long history of the Fed doing this in over several cycles. So I don't think this one will be any different. And that's kind of what the market thinks too. Anyways, I am seeing activity pick up. It felt really quiet there for a few weeks when rates were so high, like close to that 5% mark. And then now that they've been coming off the high, I'm seeing a lot more people out there trying to get deals done. But the problem is that a lot of people don't have enough money down because they're always shocked when I run the numbers and I tell them what the property qualifies for. You just don't quite see how much loan dollars get cut when rates are higher until you actually do the numbers. So a lot of times I'm having people come to me for purchases and they're having to put down, they're having to come in with 40 or 50% down. And obviously that's not ideal for most people, or they may not have that money. So if you can't be an all cash buyer and you need to get financing, there are options out there. But let me just give you an example. I thought this would be helpful. This is an example of how loan dollars are affected. I'm just taking an 8-unit purchase as an example that has a $2.5 million purchase price, and there are $17,000 a month in gross rents. So if the rate is 7%, which is really close to that today, it would qualify for a loan of $1,325,000, which is 53% loan to value. At 6% interest rate, it qualifies for $1,475,000, which is 59% loan to value. Now, if rates drop to 5.5%, that means that same property, the $2.5 million purchase price with a $17,000 a month in gross income, qualifies now for $1,550,000 or 62% loan to value. So, of course, I'm giving you an example of a property that's in a San Diego market, that's in a like a better part of San Diego also. So even at 5.5% interest rates, it's qualifying for 62% loan to value. But the biggest thing I wanted you to see is that from 7% to 6%, that's 4% LTV, which can be pretty significant if we're talking about a 7-digit purchase. And from 7% down to 5.5%, it's an almost 10% loan to value. So that gives you an idea of what higher interest rates do to loan dollars in a high interest rate environment and what the potential could be when rates go down. Yes, I didn't say if, I said when, because it's definitely going to happen. We probably won't see anything with a 2 in front of it, maybe not even a 3, but we will definitely see rates go down. And I agree with Bloomberg and the UBS strategists and the overall market that we're going to see lower rates at some point next year, maybe in the spring. I doubt it, but probably more like the back half or even third and fourth quarters of 2024. So if you cannot come in with 40 or 50% down, what else can you do? Now, there are options outside of conventional banks or even Fannie Freddie. So if you're planning on renovating and increasing the rent significantly, you can also qualify for bridge financing, which can also include renovations in the financing. Or if you own other properties, this isn't your first investment property, or you own other real estate, it's possible that you could get a line of credit on another property you own already to help you fund the down payment, to help you fund renovations on the property, or to add ADUs, because that's the big game here in California right now, or at least Southern California, San Francisco. You know, they're doing that in multiple areas in California. It's become very popular. So that's the one thing. A lot of lenders can't do construction loans for ADUs, especially if you're building 1 or 2. It's just not enough for them to justify doing fund control and all the crazy things they have to do for construction lending. So a line of credit is a really good idea. And that's what we've been doing a ton of over the last year or so, not just for ADUs, but also for opportunities as they come up, because people want to have that cash waiting on the sidelines, ready to take action. Now, realtor commissions. I haven't talked about this. This is obviously passed. It's like a $1.8 billion lawsuit that's essentially going to get rid of sellers paying buyers agent commissions. It's crazy because this is the way we've always done it. And somehow it's like not as if sellers weren't able to negotiate commissions with their agents. Sellers always knew that the commission goes to pay usually 50% to the buyer's agent and 50% to the seller's agent. And we all live in a market where the property sell, or the value of a property is what the market is willing to pay. So somehow they think that agents are colluding together to get the prices up. Nobody's holding a gun to your head or forcing you to buy properties or to pay a certain price, but somehow probably someone who doesn't know much about real estate got involved and they won this lawsuit, these homeowners that got together. And now I think there's a lot more getting together that are going to try to sue as well, because why not get some money, right? For free. Jump in on that class action lawsuit. Anyways, my opinion on this is it's basically going to get rid of a lot of agents, because only the best are going to be able to survive. The best are going to have to justify why a buyer should pay them a commission, which I believe they do. Let's think about this. After the last financial crisis, right? The great financial crisis of 2008, what came out of that? A bunch of really bad loans, which then triggered all of these new rules and, disclosures and all this stuff for the unknowing home buyer, first-time home buyer. So now you think that the unknowing first-time home buyer isn't going to try to save money and represent themselves so that they don't have to pay someone. And you don't think that's going to be a nightmare for buyers agents who are going to have to deal with these inexperienced first-time home buyers. Now, hopefully they're going to sort of get weeded out, because they're not going to get offers accepted if they're representing themselves, knowing that this is going to be a difficult transaction. So now some of these buyers that are not willing to pay representation are going to be disadvantaged if they aren't willing to hire a realtor, which may force them to go ahead and hire one. Who knows? There's a whole slew of things. There's a lot of different, ways that this thing could go. But the bottom line is, if you are a buyer, even for me as an experienced buyer, I would like to have an agent representing my interests and fighting for me. Like you don't want to have to deal directly with an agent. You don't know all of the strategies. You don't know the lingo if you're new in the business. And even if you are, it's good to have someone on your side to help you see maybe something that you didn't see. So anyway, we will see what happens with this. It's kind of crazy, but apparently they don't pay sellers don't pay buyer commissions in other countries, and we're one of the few that do it. So it remains to be seen what's happening. But I think the one thing that we can all agree about is that real estate in general is getting attacked from all sides. I mean, we're getting attacked with higher interest rates. We're getting attacked with like skyrocketing insurance. Some people can't even get insurance, or I've heard crazy stories of it being 10 times the cost. So we're getting attacked on that. We're starting to see that rents are flattening out and we're having to offer more concessions. Banks are pulling back. Financing is harder to get, not just because of higher interest rates, but because there's less banks out there lending. And now there's all these regulations happening in California at the state and local level that are making it tougher for landlords to do their job, because apparently the political governments that officials feel like they can get into our business and help us manage it better than we were doing it. So real estate in general is getting attacked from all sides. This is a serious issue. It's very challenging for us right now. And we're going to have to stand up for ourselves and not just say it is what it is. What's happened is going to happen. We've got to get involved and try to do something about this, because there's a lot of things coming down the pipe that a lot of people might not know about. So we're just under attack right now in general. Now that said, let me speak on this occupancy vacancy thing. I am seeing locally in San Diego, and it's also showing in the data nationwide, obviously different markets. Some markets may be stronger than others or weaker than others. So it's really market to market. But in San Diego, I'm hearing from my property manager, I'm hearing from other owners that vacancies are sitting a little longer. Now, it's hard for me to say that vacancy is increasing and it's a result of the market. I do think it's somewhat a result of the market. But one thing that I think we're forgetting is that post-COVID, since COVID, we didn't have like a normal market for vacancies. Prior to COVID, this was a slow season. Right? So kind of like end of October through like February was considered the slow season. You wanted to try to strategize and not have vacancies around the holidays and just after the new year. It was just a thing. So it seems that we are returning to some sort of normalcy. I don't know if we're truly seeing a decline. I think we might be just seeing the market normalizing a little bit, as much as people hate to say it. But being in property management for years before that and owning properties, I remember those days. So it all remains to be seen. But I am definitely hearing more concessions are being offered. Vacancies are sitting longer. And in this market, whether you're a buyer or a seller or a landlord, you're better off to rent that unit quickly, to sell that property more quickly, and not try to hold out for the higher rent. That is not the market that we're in. It is truly a buyer's market or more of a renter's market right now, because there is not as much demand as there has been in the past. Like, we've been riding this beautiful wave where it's been a buyer's market and a landlord's market. We can kind of call the rents. We can make people be more competitive. We are not there anymore. So if you get a good tenant that qualifies, that wants to pay you maybe $50 less than what you're marketed at, I would say go ahead and rent that unit and get it filled. I would say give that concession. So you've got to strategize on that. I've got more strategies as well to it. So if you have questions, reach out to me, because I do have some strategies in regards to what's better, to give concessions or to drop your rents. But you guys have a fabulous week. Reach out to me with anything. As always, if you got a rate quote or a loan quote last week, go ahead and get that refreshed this week, because things have changed. All right, have a fabulous week. I will see you next week.